The risk comes from not knowing what you're doing. Warren Buffett. This simple yet powerful phrase encapsulates the essence of the golden rule for making financial decisions. How many times have you felt uncertain about deciding where to invest your money or how to manage your personal finances? Many people face this dilemma daily, and that's precisely where his principles can make all the difference. Warren, known as the Oracle of Omaha, built a billion-dollar fortune by following solid financial rules and timeless principles. His approach is not based on tricks or shortcuts, but on discipline, patience, and deep knowledge. He believes that the foundation for any sound financial decision is a clear understanding of what you are doing and why you are doing it. But how can you apply this wisdom to your financial life? The golden rule for financial decisions is simple: invest only in what you completely understand. This means avoiding complicated investments, get-rich-quick schemes, and impulsive choices. He emphasizes that financial success does not come from luck, but from the constant pursuit of knowledge and the discipline to apply that knowledge. Imagine you are about to invest in a new tech company, but do not understand how it generates revenue or its business model. He would tell you to stop and study before investing. This principle prevents decisions based on rumors or fleeting trends and focuses on a real understanding of the investment's value. This approach is not limited to major investors. It applies to anyone seeking financial stability and growth, whether buying stocks, starting a business, or even planning your personal budget. Deeply understanding where your money is being allocated is key to minimizing risks and maximizing returns. And that's exactly what we'll talk about in this video: how you can apply Buffett's golden rule to your daily financial decisions. We'll explore practical strategies, real-life examples, and powerful insights to help you make financial decisions with greater confidence and wisdom. Get ready to transform the way you handle your money by learning directly from one of the greatest investors of all time. He didn't build his fortune by betting on trends or following what was popular at the moment. He followed a simple yet powerful principle: deeply understanding where you're putting your money. This may seem obvious, but most people fail at exactly this point. The eagerness to make quick money drives many to invest without understanding what they're buying, and that's where significant losses occur. Warren has always emphasized the importance of investing in solid businesses that you can understand. He states, "Never invest in a business you cannot understand." This principle protects investors from being lured by fads or complex investments that promise quick returns but conceal enormous risks. Another essential pillar of the golden rule is the long-term mindset. He believes that patience is one of the greatest virtues in the world of investments. Instead of seeking quick profits, he invests in companies with strong fundamentals and sustainable growth potential over the years. A classic example of this is Berkshire Hathaway's investment in Coca-Cola. Warren began investing in Coca-Cola in the late 1980s, after the stock market crash in 1987. He saw value in an established brand with a simple business model and stable global demand. Decades later, this investment continues to generate billions of dollars in dividends and appreciation. This example teaches us that by deeply understanding a company and believing in its long-term potential, we can reap consistent and solid rewards. He doesn't worry about short-term fluctuations because he knows that a good business will always appreciate over time. Warren also emphasizes the importance of investing in businesses with durable competitive advantages. He looks for companies with a kind of economic moat, meaning something that protects them from competition and ensures steady profits. This moat could be a strong brand, exclusive technology, efficient distribution network, or customer loyalty. A great example of this is the investment in Apple. Although he traditionally avoids technology companies, considering them difficult to understand, He made an exception for Apple because he saw it more as a consumer company with an incredibly strong brand and a loyal customer base. This gave Apple a clear competitive advantage. The result, Berkshire Hathaway's investment in Apple became one of the most profitable in the company's history. Warren has always warned about the dangers of speculation. He sees a clear difference between investing and speculating. Investing involves analysis, understanding, and focusing on the intrinsic value of an asset. Speculating, on the other hand, is betting on price movements without solid fundamentals. He states, the stock market is a device for transferring money from the impatient to the patient. This means that those seeking quick profits, buying and selling stocks based on rumors or emotions, often lose money to those who are disciplined and patient. To illustrate, think of market bubbles like the dot-com bubble of the late 1990s. Many investors were seduced by the explosive growth of tech companies with no real profits. He, on the other hand, avoided this sector at the time because he couldn't understand the business models of those companies. When the bubble burst, many lost fortunes, while Buffett kept his investments safe and solid. He is living proof that lasting financial success is built on three fundamental pillars: patience, precise evaluation of opportunities, and unwavering discipline. Warren often says, the stock market is designed to transfer money from the impatient to the patient. This statement reinforces the value of patience in investing. In the world of finance, where everything feels urgent and opportunities seem to vanish in seconds, patience can be seen as a competitive advantage. One of the most striking examples of Buffett's patience was his approach to American Express. In the 1960s, American Express faced a financial scandal that caused its stock to plummet. While many investors fled in fear, he studied the company and realized the scandal didn't impact its core business model. Taking advantage of the undervaluation, he invested heavily and over time reaped impressive returns. This episode demonstrates how patience, combined with rational analysis, can turn crises into significant opportunities. Another key principle of his philosophy is the search for undervalued stocks. He operates on the premise that a stock's price doesn't always reflect its true value. This gap between price and intrinsic value is where he identifies investment opportunities. To achieve this, Warren applies the concept of margin of safety, a principle inherited from his mentor, Benjamin Graham. The margin of safety involves buying assets at a price significantly below their intrinsic value, reducing risk and increasing potential returns. For example, during the financial crisis of 2008, while panic gripped the market, he saw value in solid companies trading at extremely low prices. He invested billions in giants like Goldman Sachs and General Electric, securing favorable terms and massive profits when the market recovered. This type of analysis and the courage to act when everyone else is fleeing is what separates ordinary investors from exceptional ones. Warren has a famous phrase that summarizes his stance during crises: be fearful when others are greedy, and greedy when others are fearful. This mindset allows him to seize opportunities that arise in times of panic. During the crisis of 2020, caused by the pandemic, many investors sold their shares out of fear. He, on the other hand, remained calm and analyzed the situation. Although he sold some strategic positions, he stayed composed and waited for better opportunities. This behavior stems from a long-term mindset and confidence in market fundamentals. The lesson here is clear: financial decisions should not be based on fear or greed. Evaluate rationally and remember that crises are temporary, but good decisions can yield lasting returns. Buffett doesn't chase the latest trend. His strategy has always been grounded in consistency. He maintains strict discipline in his decisions, avoiding being swayed by emotions or fads. A clear example of this discipline is his resistance to investing in businesses he doesn't understand. For years, he avoided technology companies because he felt he didn't fully grasp their business models. Only when he recognized Apple as a consumer company with a strong brand and loyal customer base did he decide to invest. That decision became one of the most profitable investments of his career. This approach reinforces that there's no harm in saying no to investments that don't align with your understanding. In fact, Warren believes that the ability to say no is one of the key qualities of a good investor. Throughout this video, we've explored the golden rule for making financial decisions. Invest only in what you completely understand. This simple yet powerful principle is the foundation of a successful journey that has made Buffett one of the most respected and admired investors in the world. We've learned that the combination of patience, discipline, and the pursuit of deep knowledge is essential for achieving consistent results in the world of investing. Warren has shown us that it's possible to build wealth in a solid and secure way without relying on shortcuts or risky bets. If you want to transform your financial life, the journey begins by adopting Buffett's mindset. Seek knowledge, be patient, and act with discipline. Remember, you don't have to be a billionaire to apply these principles. You can start now with what you have, taking steady steps toward financial growth. If you enjoyed these lessons and want to learn more about achieving financial success inspired by great investors, don't forget to like this video and subscribe to the channel. That way, you won't miss any content that can transform your perspective on finance and investments. See you in the next video. See you in